Good afternoon, everyone. Good afternoon, all the panel members and participants. A warm welcome to today's session regarding the accounts, audit, and taxation of charitable trust, which is the part 2 and which is hosted by Direct Tax Committee of ICI. It is indeed a pleasure to have you all here. Thank you. Today, we have the privilege of delving into the intricate realm of taxation concerning the charitable trust, led by esteemed Dr. C.A. Falguna Kumar sir. In this session, we will explore the fundamentals and nuances of taxation which are applicable to charitable trusts, paving the way for a deeper understanding of this crucial aspect of taxation. Let's embark this enlightening journey together as we uncover the complexities and best practices in navigating the taxation landscape for charitable entities. Dr. C.A. Falguna Kumar sir, an esteemed chartered accountant with over 45 years of experience with an impressive array of degrees including MA, MCom, MBA, DISA and PhD, alongside memberships in prestigious professional bodies. Dr. Kumar sir's expertise spans tax, governance and academia. His prolific career features over 500 technical papers, numerous lectures, and active involvement in charitable institutions, reflecting his dedication to advancing both the accounting profession and societal welfare. However, we have Dr. Falguna sir. We had him in the part 1 of the charitable trust, wherein a thorough explanation of section 46, that is 1046, section 1046A, do's and don'ts while applying for registration, important pointers for Form 10AB, how will the scrutiny matters will be attracted, and of course, the comprehensive chart of compliances, section 12AB, that is subsection 4 and 5, that is for cancellation of registration, were also covered. So today, we shall proceed towards the account, audit, and taxation of charitable trust. We are truly honored to have you, sir, here. Your presence enriches our session immensely. Before we invite Dr. C.A. Falguna sir to share his valuable insights on the topic, I would like to introduce C.A. Piyush Sajit sir, the chairman of DTC ICI, who is a practicing chartered accountant for the last 20 years. He specializes in direct and indirect appellate proceedings and arbitration proceedings. He's a speaker on various topics of direct tax, a member of external committee of Reserve Bank of India's Asset Reconstruction Committee, a vital contributor to WIRC publication on Vivad Se Vishwas scheme, and is also practicing litigation in direct as well as indirect tax. However, since he is not available today, I would like to request CA Kota Srinivas sir, the Vice Chairman of DTC ICI, to provide the opening remarks and to give an overview on the topic, accounts, audit, and taxation of charitable trust, which is the part 2. Before that, let me introduce CA Kota Srinivas sir. CA Kota Srinivas sir is a distinguished chartered accountant from Bengaluru with a BCom degree from Bangalore University and fellow memberships in both the Institute of Chartered Accountants of India and Institute of Cost and Works Accountants of India. CA Srinivas sir has devoted over 2 decades to serving the accounting profession. His extensive contributions, including leadership roles in various committees and councils, notably as chairman of the Bangalore branch and the SIRC of ICI. Under his stewardship, initiatives such as distributing backpack bags to CA students and conducting numerous educational programs, including the annual regional residential course on international taxation, have significantly impacted the profession. C.A. Srinivasa's commitment to innovation and service is exemplified by his involvement in diverse projects and groups aimed at enhancing member welfare and professional development. He is fondly known for his motto, Think Differently, Act Perfectly, encapsulating his dedication to excellence and forward-thinking approach. So I would request C.A. Kota Srinivas sir to proceed ahead with the opening remarks plus giving the concept clarity on today's topic.
Thank you. Thank you, Akshata. First of all, accepting our invitation from DTC to be a moderator for the day's session. Let me wholeheartedly welcome my good friend, Dr. C.A. Falguna Kumar from Tirupati, who has accepted our invitation to share with us the nuances of this charitable and religious trust. As also, I welcome the Secretary of DTC and the staff of DTC, the CA Priyas Gurmanyam and CA Sharma, who is there, and other people who is part of this particular webinar, and all the members who have logged in for listening to this particular important topic of the day. In fact, when we approached Falguna Kumar sir, he said it is very difficult to deal with these topics within 2 hours. So he gave us, he said we will do this particular program in two parts. First one part where we will talk about registration and other requirements. What is definitions of charitable and religious trust and the registration formalities. And second aspect, second part, we can talk about the how to apply this particular income and what all the taxation matters. So this, which is very, very most important that we thought we will have in two parts. And we fixed the Falguna Kumar sir for first part. And then we thought we will have, we'll find another speaker for the second part as such. So we wanted some change. But seeing the response of all the members over here and even our, I think the DTC, I think Rudrakshi is taking care of all these webinars with respect to direct taxes. With those people also, they said that no, sir, let us have the same person to take us through these particular provisions, which are important provisions. So that way, I think we have fixed this particular day, which is for the direct tax webinar. As you know, DTC is doing webinars on every Thursday. 1 week we do on direct taxes. The other week we talk about international taxation, which is part of the our DTC scope. So next 2 weeks we will be discussing on Section 9, the importance of Section 9 in detail in the next 2 weeks. So today we are talking with this charitable and religious trust, more so with respect to the exemption availability and taxation matters. As I said in the last meeting also, Falguna Kumar had a privilege, or I should say very, very fortunate to be, one is in the Tirupati and second one is to have an opportunity to serve the Tirupati Tirumala Devasthanam Trust, various trusts. He was an auditor for so many years and maybe now also he may be there. I'm not aware of his latest profiles, but he was auditor for this particular trust for various years. So we all go to Tirupati to do donations, but this person goes and see first, collects all those things, counts all those money and say how to use this particular donations, how effectively it has to be used, how religiously it has to be used so that it will not be subject to taxation. So he'll be guiding, or I should say he's a consultant for God. We go to the God for consultation and getting the blessings, but God has to talk to Falguna Kumar to give the consultation of how to properly plan his taxation. Jokes apart, let me tell you this, when we have a discussion with the CBDT chairman, last month we went to make a presentation or give us a pre-budget memorandum from BTC event. They are also very, very particular, more so with this particular charitable and religious trust. The CBDT chairman was saying, or I think even recently I met the commissioner of principal chief commissioner of income tax in Bangalore. He was also mentioning some of the cases, like you were giving an example, like Tata company, where they had a very, very big charitable trust as such. They said we cannot run this charitable trust. We would like to surrender our exemption, because there are so many changes in income tax. Maybe to just to what I should say, to curb some of the malpractices. So many things have been implemented, but for the genuine trust also it is affecting a lot. So there are so many, I should say, what I should say, the amendments that has taken place in the last 3 years, 3 to 4 years, so many amendments have happened. Like first of the amendment, if you say like the registration started 2 years back. So there was no proper registration for the trust. They said everybody has to re-register. So as either as a provisional registration or final registration 3 years back, all the trusts started their registrations, either 1023C registration or 12A registration or ITG registration that started. Then so many things they brought in, like when once you spend money out of corpus fund, it will not be allowed as application until unless that has been replenished. The loan amount utilized will not be considered as application until unless the loan has been repaid. And whatever you pay, it should be on cash basis. On credit basis, if you make a entry, that will not be considered as application. So there are a lot of changes that has been made. Of course, Falguna Kumar sir will take us through all those things. The last year there were some 2-3 changes. Like I said, the corpus fund if you use the corpus fund for charitable purpose, it will not be considered an application till the year when once you are repayments, replenishing that corpus fund or putting that amount in investments as specified under section 11 subsection 5. Similarly, loan repayments. So only when once you make the repayment of the loan, that will be considered as application. But there is a clause that was brought in from last year where this replenishment of amount to the corpus fund and loan repayment should be within 5 years from the end of the previous year when this actually amount has been spent. The other amendment is whenever you are making donations to similar trust, say suppose a trust is there which it cannot spend full amount for application of certain things, objectives. So similar trust, if it is sending that means making such donations, that was also allowed as application. From last year, there's an amendment where it says if you donate that amount to similar trust, only 85% will be allowed as application, 15% will not be allowed as application. So like this, there are so many things and there are some specified income where there is small deviations also, it will be subject to taxation under various sections at 30%. And there's 115 PT, I think, where accredited income is there in case of trust, that is also taxable. So there are a lot of things, lot of provisions which one has to be understanding. But one thing, only I should say relief is most of the 1023C provisions and section 11 provisions have become unified. Like there is all similar to us. In fact, I told the CBDT chairman also that let us scrap this 1023C, sir, because same thing, duplication. Now you cannot have two registrations. That one proposal also they kept. We don't know what will happen back. So now in this next 2 hours, I feel Falguna Kumar sir will take us through each and every provisions of the charitable and religious trust with respect to the taxation and how to maintain books of account. Because as chartered accountants, many things we have to know. Then only we can guide our clients how it has to be maintained. So one more amendment is there with respect to filing of Form 9A or Form 10, where it has to be filed. Earlier, it was supposed to be filed before filing the income tax return under section 139, due date before 139(1). Now it says 2 months before you have to file Form 10, meaning the due date for filing the return is, say, suppose 31st of October, Form 10 should be filed by 31st of August, meaning the audit should be completed by 31st of August. So all these practical issues are also there. I once again welcome Falguna Kumar sir for this particular webinar, and I welcome all the participants who are there virtually. I hope at the end of 2 hours, you will, lot of your queries, whatever is there in your mind, will be clarified. But still, if you have some queries, definitely he will answer all those things. I once again welcome all of you to have a happy learning. Thank you, Akshata, over to you.
Thank you, CA Kota sir, for the insightful overview of the topic. Now I request CA Falguna sir to initiate with the technical session. Over to you, sir.
Yes. Om Namo Venkatesaya. Esteemed Chairman of the Direct Tax Committee of ICAI, Sri Piyush Chajil sir, in absence here. Vice Chairman, Sri Kota Srinivas, my good friend, who is always wishing the knowledge sharing as top priority. The moderator, Shita Dan, and CA Priya Subramanyam and CA Rudrakshi Sharma, and all the viewers. So, last month, April 18th, I have been given the job of discussing the overall view of the taxation under the Income Tax Act. Several provisions were unconditionally exempted, some conditionally exempted, and the first regime 1023C, how unconditionally having 8 provisos, first 4 provisos without any registration, income, total income can be claimed exempt, and then the registration, new registration procedure, the conditions for availing them, and then the cancellation procedure, all that we have seen in the first part. Now, the most crucial and important part, that is the chartered accountant's role, is in getting the trust accounts audited, and then when the SSC files the return along with this chartered accountant's audit report, he must be able to get the exemption as envisaged in the Income Tax Act. But as Kotha Srinivas has explained, in the 3-4 years, in the past 3-4 years, there is a substantial change from the government, from the department side, from the CBTD. Number of conditions have been envisaged. So these conditions, unless one satisfies cumulatively, ultimate exemption availment is not possible. Though they have the registration, though they are satisfying the conditions as per the statute, the procedural conditions also have to be satisfied. And having satisfied all these procedures, substantive law and the procedure law must obtain the auditor certificate, and that auditor certificate also 1 month prior to the due date of filing of the return. As is rightly said, October 31st is the return filing due date. Then by September 30th, the audit report shall be filed. So, in case they are not able to apply 85% of their income, then the Form 9A and Form 10(2) routes are available. Choosing the appropriate route, they should file those things also, as he said, 2 months in advance, that is before the due date of filing of it. So the exemption given under the Income Tax Act is a separate code by itself. Normally, as chartered accountants, we are accustomed, we have been molded, we have been trained, and say our mind is in such a way that for a business concern, we prepare the profit and loss account and balance sheet, and we start arriving, though the P&L account balance sheet, to confirm the respective acts format or the normal accounting principles. Revenue, income and expenditure is there in the income and expenditure account, and assets and liabilities are drawn in the balance sheet. We start arriving the taxable income under the Income Tax Act for a businessman from the net profit making plus and minus. We try to arrive the taxable income for a businessman. The taxable income for a trust is the opposite, entirely different. The code, the computation mechanism, the principles of exemption are entirely different for trust. How it is, how to understand that, and how to arrive the taxable income, we are going to see. So I will try to present my PPT. Oh, I think my PPT is visible now. Shall I proceed? Hello? My PPT has come on the screen?
Yes,
okay.
sir. Yes, sir.
Yes, okay, I will proceed. So, the disclaimer, whatever I am giving, in addition to the act, I try to give in my presentation some of the practical ways of, solving the problem before us. So these are all my personal ideas, nothing to do with the institute. So within the provisions of the law, whatever is possible, we should try to do this. And before going to that, what I have communicated in part 1, that is the registration process, again for the 4th time, the CBTD has extended another due date, 36, the next month, 30th, June 30th, 2024 is the extended due date for those who missed the bus, that is filing form 10A or 10AB in different 4 or 5 different circumstances. That means those who got registration up to 31/3/21, that is from 22-23 assessment year, they could not get the renewal by way of fresh registration, they can even now avail, though their return would have been processed, tax would have been levied, they will all be under 154 will be rectified once a trust avails this extended due date for the registration continuation, not only for this 12-year registration or 1023 approval, but for ATG also this extended due date will apply. So this is the circular number 7 of 2024, dated 25th April 2024. So after the presentation of the first part, this has come. This is very useful. So those who missed the bus can avail this extended opportunity. We may not get once again another opportunity. So it is better we do this. So now, what is the difference between a normal business computation and the trust computation? In the normal business computation, the net income is the focus, whereas in the case of trust, the focus is on the expenditure, that is whether revenue expenditure or capital expenditure from the income, whether 85% has been applied in the same year or is not. So that is the focus, not the income and expenditure alone, which is there. Profit and loss account renamed as a income and expenditure for this trust is not the case. Only the balance sheet capital expenditure is also at par taken as revenue expenditure for the 85% application. The amount applied includes this thing. So whereas in the normal business concern, only revenue expenditure is the allowed, whereas here capital expenditure is allowed. So similarly, in the normal business income, the income bifurcation is not considered. That means the income side, whatever the income the business concern earns, they will not probe into the source of that income, and the income-based taxation is not there in the business cases. Whereas in the case of charitable trust, the income, the receipt is bifurcated into several types for arriving the exemption and the tax liability. For example, the anonymous donations. If the donation in the case of a charitable trust, for religious trust, anonymous donations are exempt. Whereas for charitable trust, if the name and address of the donor is not available, it amounts to anonymous donation, section 115 BBC, and then this income is taxable at 30%. Similarly, 115 BBI, so the specified income is there, so that specified income is taxable. Similarly, sale of assets, that specified receipt, if is not going to comply with section 11(1) capital A, again it becomes a taxable income, which is for which 85% is applicable. So similarly, in the case of a business concern, loss of 1 year can be carried forward. Not only business, even for capital gains loss can be carried forward, maximum up to 8 years. Whereas in the case of trust, loss carried forward set off is prohibited, whereas income carry forward is there up to 5 years. So for the income carry forward, you have to file the, just now as I said, form, either you can avail either section 11(1) explanation class 2, or for filing form 9A, or section 11 subsection 2 for filing form 10. So if there is a shortfall of 85%, the surplus income can be carried forward. That is, in the sense, in the coming 5 years, it can be utilized by filing this form. Then the income is deemed to have been applied in the first year. On account of filing form 10 or 9A, the income is deemed to have been applied, but actual application within 5 years, subject to 4 more conditions, which we are going to see. Similarly, the cash-based expenditure only is allowable in the case of trust, whereas in the business concern, 43 capital B, only 6 items are specified in 43B. For them only, instead of the accrual basis, the cash basis, either during the previous year or before the due date of filing of the return, if you incur that expenditure on cash base for a businessman is allowable, whereas the total expenditure, whether it is revenue expenditure or capital expenditure, here the in the case of trust, it is only applicable totally on cash basis. So similarly, the capital receipts are not at all income in the case of a normal business person. And similarly, capital repayment, like loan repayment, is not considered as expenditure. Whereas in the case of trust, loan received is not income, but loan repayment is an application, subject to certain conditions which we are going to see. Similarly, the capital receipts, like corpus fund donations, may become taxable income here if conditions are not satisfied. So like that, there is a substantial. In fact, 44AB, the tax audit with which every practicing CA is familiar. If the tax audit report is not submitted within the due date, penalty is there. So 271 capital B penalty is there. Whereas in the case of trust, the trust audit report, which is prescribed under section 12, subsection 1, small b, for all the trusts to get exemption, this audit report the trust has to obtain and file just before 1 month of the due date of filing of the return. So if the audit report is not filed, unlike a business concern where a penalty is proposed, here no penalty is proposed for not obtaining the audit report, but the section 11 and 12 exemption itself is forfeited. So once the audit report is not there, not only audit report, the accounts also. If the accounts are not maintained, if the audit report is not obtained, if the said audit report is not uploaded and got filed before 1 month, the section 11, 12 exemption is. Whereas for a businessman, if books are not maintained, it may come for his advantage because he has violated so many sections. Only on presumptive basis, some percentage of income will be taxed under the head business based on his turnover into certain percentage of income. There ends the matter, not even the 271B penalty for not getting the books of accounts audited. Whereas in the case of trust, having got the registration, they are bound to maintain the books of accounts. Such books of accounts have been specifically prescribed in August 2022 under Rule 17AA. So the exhaustive list of books of accounts have been prescribed only for the trusts which are doing either a public religious cause or public charitable cause. Whereas for the business people, irrespective of their 10,000 crores turnover, 1 lakh crores turnover, or say, irrespective of the turnover, 44AB, whenever they are doing. So such books of accounts which are reasonable for the auditor to give the 44AB tax audit report. No exhaustive books of accounts list has not been prescribed. So this is a substantial change, seriousness for this trust. So one should be very, very careful in dealing with the trust because they are giving the exemption. All these stringent conditions have been maintained. What are the books of accounts which are from 23-24? Though the trust audit is there for the past 40-50 years on the statute, but the books of accounts list has been prescribed only in August 2022, and such books of accounts prescribed are 8 types of books of accounts and 10 records and documents to be maintained. Especially the immovable property register has to maintain, mobile properties details have to be maintained, deposits details have to be maintained, the accumulation, if at all you are doing, for which year, how much you have accumulated, how much you have invested, and how much you have applied, these details, records and documents are also to be maintained as per this rule. And unless the such books of accounts are maintained and kept, so where you are keeping also in the audit report, the auditor has to specify list of books of accounts. They have given for these 18 code numbers in the audit report. So all the 18 has been maintained, or only some maintained, some not maintained. The code number the auditor has to say. So maintained, kept, where he is kept, at the registered office or any other office, in which mode, how many the auditor has examined. Failure to maintain such books of accounts and other documents, the income will be computed without section 11-12 benefit and no question of the capital gain exemption. The corpus fund donations also not accumulate what is not spent 85%. No question of application. Only if the books are maintained and audited only, then this question will arise. Benefit will be given. All the benefits are lost once proper books of accounts are maintained. So whether he has maintained or not, the burden is on the auditor while issuing the audit report. He has to say, yes, they are maintained. Then alone this exemption can be worked out. Otherwise, say exemption cannot be obeyed. So the books are not maintained means from the both capital receipts and revenue receipts, only revenue expenditure will be allowed. No other deductions will be given, and not capital expenditure will not be given. And the remaining income will become a taxable income. It is taxable. So the list of books of accounts, the cash book, ledger, like that. And in case, as we are seeing, the trusts are having 3 types of businesses also they can have. What are they? The business would have been donated by a donor as corpus initially. That is one type of business. Maybe the business is incidental to the main activity. Like, say, for example, an educational institution is buying the textbooks and notebooks and then selling to the students. It's an incidental business activity, buying and selling. So then it has to maintain separate set of books of accounts and then get them audited also as per 44AB. So these are all the requirements. So another type of business is in the case of 7th limb of the definition of charitable purpose, that is section 215, that is any other object of general public utility, GPU we call. So for them, if they have any trade, commerce or business like receipts, they have to maintain separate set of books of accounts. And if such receipts exceed 20%, then it is no longer a charitable purpose as per the definition of charitable purpose. So for that sake, separate set of books of accounts, whether for business they are maintained or not, the auditor has to examine and report. So it is the prescribed way. So similarly, the other documents like what are the institutions they are owning. An education institution may have 2 high schools, 2 colleges, 3 colleges. So the institutions' names, addresses, the donors' names, addresses, the income applied persons details. Actually, this register is very difficult. When you apply the income for public purpose, their detail, person's details, is it possible? So the expenditure details only is possible, not the person's beneficiaries details, but the act said like this, the registers are to be maintained. So the income accumulated, that is brought forward, carry forward in the sense Form 10, Form 9, there is section 11.2 and section 11.1 explanation, class 2, like that. So the corpus fund donations received and invested, a separate register. So loans and borrowings received, opening balance, received, repaid during the year. So similarly, purpose for which the loan was utilized, properties, that is, as I told you, mobile properties purchased, sold, who owned and continued. Specified persons list also, another document relevant. Like this, exhaustive list is given. For them, code numbers are given as I have shown you. So these are the books of accounts. With these code numbers, the auditor has to give his audit report. Now, the audit reports are 2 types. Small concerns, big concerns, let us say in a casual way. But what is a small concern? What is a big concern? We are going to see. Such books of accounts must give the facilitate the auditor to prepare the financial statements. Actually, CA Institute has brought out a technical guide in 2002, giving the format of the non-profit organizations' financial statements. It's a recommendatory, though not mandatory. And the accounting policies are to be disclosed because the auditor is first part is certifying the true and fairness of the financial statement. And second part, the clauses, just like in Form 3CD, the true and correctness of the facts verification is there in this Form 10B or 10BB audit report. So this disclosure of accounting policies is so important, and the consistent method of accounting has to be followed. So all these normal principles will apply even for this thing. So this is generally applicable, but the institution, the trust or institution, if it is having any business or commercial concern, then the based on the gross receipts of such a business concern, the accounting standards are applicable. As we all know, level 1, 2, 3, 4 are there. So based on this business concern, gross receipts only, the accounting standards are to be applied. So the disclosures have to be made. The bigger concerns, the audit report is 10B, the new audit report, and then the smaller concerns is 10BB. So the bigger concerns means whose gross income without any exemption is 5 crores and above. It's a first category. Who are having a Foreign Contribution Regulation Act receipts. This Foreign Contribution Regulation Act receipts means not necessarily the foreign exchange coming into India or from outside India, any money is being received with the prior registration under FCRA and amount received. For the separate account, separate audit has to be conducted for FCRA once they have a registration. The separate bank account, if it is giving during the year, there is no inward remittance at all. But already received money is earning some interest. That interest is also deemed to be FCRA receipt as per the FCRA Act. So the institute is also of the opinion that once there is a FCRA receipt, that is even the interest on the bank balance, the Form 10B audit report has to be filed. That's why last year, for the first time, 23-24, many people instead of Form 10B, 10BB audit report is filed. So the CPC said you are having some FCRA account, so you are not filed. Then the CBTD has extended the due date and allowed by a notification that those who wrongly filed the audit reports can now file the extended. That was over by March. So these are the second type of trust for whom 10B is a bigger audit report having 49 clauses, whereas 10BB for small people is having only 32 clauses. 10B is having 29 schedules, whereas 10BB is having only 6 schedules. So the bigger audit report is applicable for bigger trusts or say FCRA receipts first. And lastly, another category to whom it is applicable, this is applicable those who apply income outside India. Any trust normally is expected to apply its income only in India, unless we give such undertaking at the time of registration itself. We apply our income only in India. At the registration time itself, the Commissioner of Income Tax will not give normal. But with the prior permission of the central government and any under section 11(1)(c), small c, so the trust institution may apply outside India its income also. So whenever they apply income outside India, then also this bigger audit report has to be given. For all others, so every trust having either 1023 approval or section 12A(b) registration must submit the audit report. If it is not falling in the first category, the bigger one, then all others, the 10BB audit report is applicable. So what are the conditions to be satisfied first of all? So the general conditions to be satisfied, one has to see, then alone will be able to understand these conditions. Though I am quoting here the section 11, 12, 13 conditions only, they are a mirror image of the other conditions which are given as some 26 provisos to section 1023C. 1023C is the main section, provided, also provided further. That is, the provisos are there. So with these provisos, same conditions, almost all the conditions are there. So these conditions are to be satisfied to avail the exemption under section 11 broadly. So the registration is the first condition. During the year, if there is a change of objects, either by modification specifically or by adoption, that means a new object related expenditure is incurred, then it is adoption of object. By passing a resolution, if you change the objects, it is modification of the objects. So in both the cases, within 30 days during the previous year itself, unless they apply for re-registration, the existing registration is deemed to have lapsed. So that's the very bigger condition. Normally, the trust management, without the knowledge of the auditor or say consultant, they may, for example, an education institution, if it gives a donation to a Chief Minister Relief Fund, thinking that Chief Minister will appreciate, Chief Minister's appreciation is not that relevant. The auditor has to qualify, saying that the solely existing education institution for relief to poor, Chief Minister Relief Fund, it is given. So it is another object. So it amounts to adoption of object. Thereby, within 30 days, if during the previous year itself, it has not applied afresh, then the existing registration and the exemption lapses. So that is the seriousness. The audit submission of the audit report, already I told you, getting the audit report, the audit is such an exhaustive one in the sense, a normal chartered accountant practicing conducting a tax audit under 44 AB of the Income Tax Act is not going to certify, arrive the business head taxable income. Allowable, disallowable questions are there in Form 3CD. He verifies the facts and reports. Maybe one or two places his opinion, he expresses what is allowable, what is disallowable. But the business income computation he is not doing in this 44 AB tax audit report. Whereas this section 12 capital A 1B audit report, that is the Form 10BB, 10B for bigger one or 10BB for small people, the chartered accountant has to certify what is allowable, what is disallowable in the application money, and what is the gross income, what is the taxable income. The auditor has to certify. The exemption to the core, the chartered accountant has to certify. In Form 10B, 8 allowable items and 13 disallowable items are there in the audit report. So the class 31 of 10B, so the auditor meticulously has to take the responsibility for arriving that exempted income, taxable income, and then certifying them in the audit. Quantification till the last rupee has to be done by the auditor. So that is the responsibility. Not only the conditions, what I said, the assessee has maintained the books of accounts, a management representation letter has to be taken for all these facts to be verified, first of all. So the responsibility is more casted on the chartered. Similarly, the return of income, ITR 7, if you see the ITR 7, it will have all the 5 heads. Whereas just now we are saying that for the charitable institutions or religious public institutions, it is a code by itself, no question of 5 heads computation. But whereas in the ITR 7, if you see, all the 5 heads will be there, from house property to this other source also will be there. So why means the ITR 7 is meant for several other institutions also, but the proper filling of ITR 7. For example, one mistake one of the assessees has done, which I have dealt. For example, an education institution having a hostel. So while filling up the ITR 7, what are the gross receipts from main activity? What are the gross receipts from incidental activity? The assessee has filled up only the college receipts as main activity, hostel receipts as incidental receipts. Thereby the case is taken up for scrutiny. There are a number of decisions which say hostel or say transport charges collected, hostel fees collected, hostel charges collected is part of the main activity only, not incidental business activity. So the return filling up is also very much important. Return filling up also is very much important. In fact, I'm going to suggest out of my personal experience, unless you fill up the return where schema of taxable income, say exempted income is going to be there plus minus, audit report, though return filing is the last day, October 31st say time, last process, whereas audit report filing is the preceding that. But audit report to fill up, you see the return filing also, return filling up also ITR 7, then only it will facilitate you, it will tell you where the mistake is, how you are arriving these percentages, the amounts. So they both simultaneously keep, then first upload the audit report and then upload the, after some time, upload the return of income. So that's how the return of income filing is made a condition to avail the exemption. If the return of income is not filed, though audit report is obtained, return of income is not filed within the. What is the due date? This due date is 139(1) we say. So actually the return of income is mandated under 139(4)(c), but the CBTD has clarified the due date not only 139(1), even the 139(4), the extended due date now under 139(4) is for every SSA December 31st. Though October 31st is there for the charitable institutions audit report, the 139(1) is October 31st, whereas 139(4) due date also is liberally considered by the CBTD. So this is how this return filing has to be done. Then similarly, applying 85% is one more condition. So application of income 85% is made mandatory. So to avail the remaining 15% or less, 85% or more you should apply, thereby 15% or less is automatically exempt, provided that 15% or less also should be there as per section 11(5), mode of investments or deposits only. So this 85% shortfall, next we are having that section 11(1) explanation, or say 11(2) accumulation either in form 9A. Form 9A is most liberal compared to form 10, but the form 9A says 1 year accumulation because the income is not received in the year of receipt, or it is already received in the fag end of the financial year, it is received. So in the next financial year, immediately following financial year, if you are going to apply, simply file form 9A, which is a little bit liberal. Whereas form 10, specific income for specific purpose, not writing just like the objectives of the bylaws are writing for which purpose you are accumulating this form, filing form 10 and accumulating. Let us not repeat the objective. Specific purpose you should write. So the specific activity better you write, and then the amount has to be kept in the 11(5) mode automatically. So then this accumulation for the shortfall. Similarly, section 11(5) prescribes the modes of investment, and 11(5) also says if a donor gives some limited company, say share market limited company shares, donates, it's not there in the 11(5). So then in a particular previous year, if such a impermissible investments are received, so then within 1 year from the end of the financial year, such shares or say such impermissible modes of investment shall be converted into permissible mode. So even unknowingly, for example, several institutions, they contribute for the chits. So the institution to earn more income, instead of the prescribed modes where the bank deposits will give say 6%, if a private chit is giving 10%, 12% return, they go for it. Then it is a violation. Similarly, the cooperative banks, for example, district cooperative banks are there in the permitted list of section 11(5), whereas primary cooperative banks are not there in the section 11(5). So in cooperative banks, town cooperative bank, if you invest, you will lose. So like that, the prescribed modes of investment is a condition which one should meticulously follow. Similarly, sale of asset, capital asset. So specifically, one exemption is given that capital gains chapter is as it is not applicable to the charitable trusts or say public religious trusts. So if a sale of asset is there, if the sale proceeds are invested in another capital asset, the another capital asset includes at least in a bank FD, if you keep for 6 months, it is also an investment in a new capital asset. Thereby, its total sale proceeds is exempt. So a special instead of section 11 small a exemption. Once you complete this, it will not come in this 100% where you have to apply 85%, because for capital receipt, this special section is given. Similarly, all these positive conditions to be complied, to be satisfied, or which we have seen under section 11 and 12, whereas section 13 is negative conditions. That means what you should not fall in this. Once you fall, it becomes a taxable income. So the conditions which are prescribed in section 13(1) to 9 are this thing. Once you are attracted in this section 13(1) to 9, automatically 13(10) will make you pay the tax by a separate computation. So that is this conditions. What are they? We are going to see in detail all these things. Just I have given you the seriousness of this audit report, the scheme of Income Tax Act. To avail the exemption, one has to satisfy all these conditions, not one condition, two conditions. They are all cumulative. They are applicable in general to all these public religious trusts, whether temple, whether college, whether it is a public institution like a sports promotion, literature promotion. So whatever it may be, once they want to register and then avail these things, they have to satisfy all these conditions. So my suggestion before going to the audit, the accounts are to be maintained. The accounts are to be maintained, let us say, in such a way, on cash basis, the receipts and payment account, one has to extract. Maybe 31,323 is over. So now for 31,324, we have to extract one receipts and payment account. A summary detail. What is that? The receipts and payment account vertically is there. I divide this into horizontally two parts. First part is revenue receipts and revenue payments. Second part is capital receipts and capital payments. Why I have done this? The trust taxation, the conditions envisaged in the Income Tax Act are based on one-to-one relationship. If the particular receipt for a particular payment have you made, then it is an application. For example, normally revenue income is taken as application either for revenue expenditure, including administrative expenditure, including the objects related expenditure, or even the donation to other trusts and the capital expenditure also. So the revenue income, both for revenue expenditure and capital expenditure, if it is used, that revenue income is exempt. To the extent of 85%, if you apply, the 100% is exempt. Similarly, in the revenue receipts, if donations are there, if they are anonymous donations in the hands of the charitable trust, specifically they are taxable. To the extent they are taxable, some margin is given, either 5% or 1 lakh, whichever is higher of the total gross receipts. So then the exempted 115 BBC income also will become normal income, and the anonymous donations broadly are taxable at 30%. So that will not form part of the 100 rupees for which you have to pay. Similarly, from that source, whatever you apply, that will not be considered as application. Similarly, corpus fund donations on the capital receipt side, corpus fund donations, section 11, subsection 1, small d, are exempt, provided 4 conditions are satisfied. The corpus fund donation for which specific funds. So these are fund-based accounting. Ultimately, what I want to say, the accounting and the exemption is fund-based exemption. Particular fund, particular head receipt, particular type of payment, if you meet only, it will be considered as one-to-one, and then exemption can be availed. Say, for example, the corpus fund donations, so the 4 conditions are there. Corpus fund donation, specific donation. For example, building fund donation. If you use it in the same year for building construction, automatically it is exempt. Such building expenditure will not come part of that capital expenditure, which is from revenue receipts, normal income. So once the corpus fund donation is used for that capital expenditure, that capital expenditure again is not eligible for this offsetting of revenue income. Similarly, corpus fund donation, say for example, a student's endowment fund, scholarship fund is given. You are not supposed to use that money, and you must keep it in the bank account. If you keep it in the bank account, automatically, as per section 11(5), then corpus fund donation is not taxable income. So by chance, these corpus fund donations are not kept in this 11(5) mode, used for any other expenditure like revenue expenditure. or some other capital expenditure, which is not the intention of the donor, then in that year, the corpus fund receipts will become taxable income. And in the next year, maximum within 5 years, if such corpus fund shortfall is replenished, that is, with subsequent year's income, if that FD is made, or if that particular donor's condition of capital expenditure is met, then in that year, that is exempted from the gross income. So that is how the corpus fund donations are specifically. Similarly, sale of assets, as I told, if a capital asset or say any other asset is investment or a asset is sold, if the sale proceeds are used for purchase of asset or for section 11(5) mode like bank deposits, then it is exempted, and it will not come in the normal 100% for which 85% application we have to calculate. Similarly, loans received. In the year of loan receipt is not income. And the year of loan receipt, if the loan is used for either revenue expenditure or capital expenditure, that revenue expenditure or capital expenditure is not application. In the definition of application, they will not come because the source is loan. So in the year of repayment, there also the condition of 5 years. So, and not only that, some because though they are introduced from 22-23 assessment year, they have put a cutoff for corpus fund donations and these loans. Anything before 31/3/21 will not be considered now. For example, you have received a loan of 2020, which you are repaying, though it is within 5 years in 2024. No, it will not be considered as application. Any loan availed after 1/4/21, now if you are repaying, say for example in 23/24, it will be considered as application. So that's how the loans received also, though not considered as income, when the loan is repaid, subject to these 4 or 5 conditions, which are once again going to see in the coming slides, then it is treated as a application. So these conditions are to be satisfied. So the business receipts in the revenue receipts also, apart from the main object related income, object related expenditure, as I told you, 3 types of businesses is possible in the case of trust. Main activity, incidental activity. So the incidental activity, for example, a hospital is there, a pharmaceutical, the medicines purchase and sale. If medicines purchase and sale, either to the hospital patients or any outsiders also can buy those medicines coming to that hospital, then not only inpatients, outpatients also, or anybody else, then it is a business incidental to main activity. Separate set of books of accounts are to be maintained. Audit has to be separate. Audit has to be conducted. Then that business receipts, that business expenditure minus the surplus in the business income shall be used for the main object. The surplus in the business income shall be used for the main object. Then alone that surplus income is exempt. So like this, the one-to-one conditions are there. There may be not necessarily line item. So capital receipts may be used for revenue expenditure, or revenue receipts may be used for capital expenditure, capital payments. But one-to-one, one has to maintain separately, identify the source and identify the outflow, inflow and outflow. Unless they are separately maintained, the computation of income is not that easy, not possible. So one has to match this for the total year and then proceed for audit report and then proceed for, because if this is there, if this statement is correct or not, the auditor has to verify. So the auditor, when he takes up the ledger and the vouchers, for which object, one may have 4 objects, for let us say for example, the audit report asks, the 10B audit report asks, for which object the expenditure is incurred. The expenditure is also whether cash and cash by way of cash or by way of the electronic mode payment, bank payments. How much is cash? How much is bank mode? Each object wise the audit report is asking. Clause 31 of Form 10B is specifically asking object wise. And object wise also, how much is the revenue expenditure? How much is the capital expenditure? So to fill up that audit report correctly, to stand for any test on a later date when the case is taken up for scrutiny, whether the audit report you have given is correct or not. Right from the first day of voucher entry, the accountant, the institution must maintain the books of accounts in such a way that after the close of the year, when the audit is there, all that the auditor has to report must be culled out, culminated from the accounts. So the institutions must be instructed to maintain their books of accounts in such a way that it will facilitate more transparently the requirements of the audit report. So the audit report prescribed last year, first time the 23-24 assessment year, we have seen very tough time. A tax audit, even for a 500 crores turnover tax audit, which you can complete in 1 week to 10 days, whereas a trust of having that 50 crores gross receipts also will take more than that time, than 44 AB time. So like that, because the details required, details to be ascertained and then to be certified as true and correct by the auditor are much more. So the object-wise receipts, object-wise the payments, cash payments, bank payments, that is electronic mode payments, all these have to be separately taken care of. Similarly, we will go into detail. Just I have given this out of practical experience, though it is not prescribed in the act or the rules, for practicality's sake, unless we have an overall idea and then proceed further, then only it will be possible for us not to commit any mistake and then not coming back and then this thing. So audit objective is the positive conditions are to be satisfied. If 85% is not applied to file form 9A or say form 10, the negative conditions not to get attracted, because only for the objectives the income has to be used and say the investments are to be there only as per section 11.5 and no payments are there to the related parties as defined in 13.3. So there should not be any rate. There can be a related party transaction, but it should be reasonable. It should be with adequate security. So the words reasonable and adequate security are used in section 13.2. So unless they are satisfied all these things, that the related party transactions may make the institution have taxable income. So the specified violation we have seen in the first part, a registration can be cancelled. So the specified violation. So while doing the audit, the auditor has to certify whether is there any specified violation. What is that violation if it is there? If not, no specified violation. The auditor in the audit report has to certify this fact. So this fact, it has applied income only for the objects, no other objects other than the registered objectives it has applied. The auditor has to certify positively, whereas the conditions are here negative conditions, no negative condition attacked. The business other than incidental, no other business has been taken up, it should say. Separate business accounts are maintained, it should say. There is no private religious objective, so it has not been applied for a particular caste or say a particular group. So that's how these things are. These are all given in the definition of a specified violation. So because the auditor, for all these things, there is no violation, auditor has to certify. He must examine during the audit and he must take to that extent the management representation letter that all these are not attracted. So the management should give their representation and then auditor, after verifying only, can give the positively a clean report. So that's how the activities are all genuine. So they have to give. So as per the registration, it has not violated any other law, the auditor has to. So for example, educational institution, under the Right to Education Act, some conditions are there. The prohibition of the capitation fees, another law is there. So the education institution, towards its main objectives, whether it has complied the other law like Right to Education Act or say prohibition of capitation fees, all these things the auditor has to verify and then certify. So similarly, every year in the audit report, he must go back to the original registration application. In the original registration application itself, nothing is false, nothing is incorrect. nothing is omitted. So full information is given in the form 10A or 10AB. The auditor has to certify every year in the original application. So if it is not there and it amounts to violation, which results into cancellation of registration. So the depreciation part, let us say, if the fixed assets are there from 15-16 assessment year, section 11(6) was introduced. What this section 11 says, any capital expenditure of a capital asset, if it was claimed in the year of incurring as application, such a capital asset depreciation, though for accounting purpose every year you calculate and claim as depreciation as a to get the true and fairness, is not eligible to form part of application. I repeat, those fixed assets, those capital assets whose cost in the year of incurring has been claimed as application, that much cost is not eligible depreciation. That much cost, a relevant portion of depreciation is not in subsequent years to be considered as application. This is stated in 11(6). In other words, for example, a college is constructed with a loan, college building. So the loan is not income. College building constructed is a capital asset. It is not an application in the year of construction. So subsequently, the loan is repaid, loan repaid is taken as application, and also the depreciation of that building is eligible application. Why? Because in the year of construction, it is not claimed as application. Capital expenditure is not claimed as application. Then the depreciation relevant to that building is an application. So what I say, your fixed assets must be from 15-16 onwards. Two types of fixed assets. Those fixed assets depreciation schedule whose cost has already been claimed as application. Second type of fixed assets whose cost has not been claimed as application. So second type of fixed assets relevant depreciation. Though for all the fixed assets you debit the depreciation to the income and expenditure account. The second type of fixed assets depreciation is eligible part of application. So the auditor has to certify in these audit reports, new audit reports also this fact. There is no duplication, one should say. Similarly, the 40 capital A3 and 40 AIA. 40 capital A3, more than 10,000 rupees payments. For transport charges, 35,000 limit is there in 40 capital A3. So 40 AIA, any payment to a resident where TDS provisions are applicable. So then without TDS, if that expenditure is incurred, so that expenditure 30% shall be treated as income. So the section 11(1) explanation 3 says, mutatis mutandis, these two sections of business are applicable from 1920 assessment year. So while doing the audit, we should be careful that whatever is disallowed here, cash payments 100%, and then TDS payments for non-compliance 30% will become taxable income. So though 100 rupees received, 100 rupees income, 100 rupees applied, but these violations are there. To the extent of these violations, it becomes taxable income on which tax has to be paid by the trust. So similarly, any other law, as I have already explained. So these are all the amendments which are having a greater bearing. Now I am going to this corpus fund donations from 22-23. So the corpus fund donations conditions are applicable even to the loans also. So the corpus fund donations conditions are, the corpus fund money shall be kept as it is in the specifically maintained specifically. There is a permissible mode, section 11(5) deposits. Up to what time? So actually the shortfall, if it is there, in 1 year, though that shortfall can be made good in the next 5 years. So the first year when the corpus fund is used for revenue expenditure for the objects or for capital expenditure object, that a revenue expenditure capital expenditure will not be treated as application and the corpus fund will become taxable. And in the subsequent 5 years, whenever from the ordinary income, if this is a deposit is made good, that is corpus fund is replenished, then it will become. So the 11(1)(d) and the loans borrowed also same way. That is against these things, no question of set off of losses or any allowances or deduction is given. So the separate computation is for loans. The registers also are to be maintained. As I said, books of accounts are to be maintained for corpus fund donations, and in which mode, in which year, how you have shortfall, how much is there. Similarly, for loans and borrowals, also a separate register of loans, opening balance during the year received, repaid, and availed, how the current year loan received is used for which purpose. Details are to be maintained. They are becoming the schedules of the audit report. Though registers copies are becoming schedules of the audit report, and this audit report 10B is having 29 schedules like that, either for corpus fund or for these loans, like that number of schedules. So one has to fill up these schedules and then come to the audit report, and then along with the return, they should be matched. So like this, these are the conditions. So the corpus fund donation conditions, as it is applicable to for loan repayments also, 31/3/21 is the cutoff date, because these are the new amendments. They don't want to go back to those earlier years and then verify and then give the carry forward benefit. They have put the cutoff date as 31/3/21. From that date onwards only these new conditions. So even then the corpus fund shall not be used for outside India expenditure. So these corpus fund donations shall not be used for other trust corpus donation. So even your normal income, why corpus fund? Even your normal income, if you give to the similar objects, another trust corpus fund as a donation. Donation is an expenditure, but you should give a normal donation. But if you give a corpus fund donation to the other trust, then it will not be treated as application at all. So similarly, 48(3) and this violation shall not be there even for this expenditure. The loan received, when you are, because it is not a loan receipt as not income, loan utilization also is not income if you consider, but loan utilization with satisfaction of this 40(3), 40(a), not that violation should be there in that. From your normal income only, this two sections will apply. One should not think. Even for this loan received, utilized for some expenditure, also these conditions will apply. That's why they said either for corpus fund money or for these things, in the year of incurring, if you satisfy these conditions, then in the year of replenishment, either loan repayment or corpus fund made good shortfall will be treated. This is how you should look at it. So the 11(3) restrictions, that is, if shortfall is there in a 1 year of 85%, one can file Form 10, and Form 10, once filed, within 5 years it should be utilized. Earlier, before the amendment, it will become taxable income even if it is not used in 6th year. That is removed by the amendment, and within 5 years it should be used. In the 5th year, if it is not used by, say for example, it will become income in the 5th year. For the 4 conditions to be satisfied for this 11(2) are, Form 10 should have been filed in the relevant year in which you have got surplus. 2, that surplus money should be specifically in earmarked 11(5) deposit. 3, that earmarked deposit for that purpose only for which Form 10 is filed should be withdrawn and used for that purpose within 5 years. 4, if by chance the purpose is not possible to be used, then under 11(3)(a), they should go to the assessing officer. Sir, the principal purpose, I have applied Form 10 4 years back. Now 5th year is nearing. I am not able to use it. Give me permission for another purpose. The assessing officer will give the another purpose permission. Then by 5th year, if you use it, then only you are satisfying these conditions. Otherwise, it will become a taxable income. Under taxable income under section 115 BBI. So if these conditions are not satisfied, actually the taxable income of a trust is 3 types, which we are going to see at the end. So now itself I'm saying the conditions are to be satisfied. Then application of income, as I told, both the revenue expenditure and capital expenditure shall be considered together as an application. There is no distinction between revenue expenditure and capital expenditure. They should be paid, not payable. Actually, the TDS conditions, many of the 194 TDS sections like 194C contractors payments, or say some other these things, not only on payment basis. Only 192 salaries on payment basis TDS will attract. For many of the TDS sections, the amount due to third party on due basis TDS has to be deducted. So the application, when it comes only on cash basis in the relevant previous year, it will be taken. So in the relevant previous year, the paid money of revenue expenditure or capital expenditure only is considered on cash basis. So similarly, the shortage of that cash basis, we can apply for 9-year Form 10. So from the assessment year 24-25, a peculiar thing has come. From the assessment year first time 24-25, if you give if the trust gives any donation to another trust or institution having similar objects, then it is for revenue, not for corpus fund. General donation, if you give, then also 85% only will be treated as application. The remaining 15% is not eligible as application. But for example, they are having only 100 rupees income. All that 100 rupees they are given to another institution. Then 85% is considered. But the remaining 15% they need not accumulate. Whereas in the normal circumstances, you are having some other 100 rupees income. And that 85% you are not able to utilize for your objects. Then even if you utilize 85%, the remaining 15% you have to keep in 11.5 mode deposits. So only for this amendment, a clarification is given by the CBTD by way of a clarification saying that though 15% is made taxable by the Act, CBTD by its clarification has said 15% need not be taxed because for want of the deposit of 15%. So whereas for the other sections, one has to apply 85%, and then though it is for objects only, the remaining 15 must satisfy section 11.5 mode. So the income side, as I said, normally the FCRA grants or CSR, corporate social responsibility events, or even government grants. Government also gives grants to non-profit organizations. Whenever they give, they attach some conditions. Whenever they attach the conditions, unless those conditions are fulfilled, it will not be taken on the income. That means the moment the grants are received, the funds are received, it will be a liability only because it is not income. It is not an unconditional grant. Unconditional grant will become automatically income. But these conditional grants will become liability in the first place in the balance sheet. And to the extent you use for their application, to that extent you transfer from liability to the income side. And as you have utilized, the expenditure will come on the debit side of the expenditure account. That's how the accounting treatment has to be done. But to be on safer side, the interpretation may come because on receipt basis, you received the grant, maybe conditions. It is to be on safer side, better you file form 10 or 9A to the amount which is there in the balance sheet as a to be spent grant also. That's only my advice, to be on safer side. Government grants too cannot be taken as income. I am giving you a decision. So that's how these things are there. Then the New Noble Educational Society. So the New Noble Educational Society is solely existing for education. If you come in the first regime, 1023C, it must be solely existing for education. No question of any other commercial activity. So actually they said in the subsequent renewal stage, if the state government is prescribing any other registration, these education issues also should fall in line, must take that state government registration also before having the registration under the Income Tax Act. That is the decision's effect. Similarly, the Ahmedabad Urban Development Authority decision is also in many respects a very crucial and important one. Why? In the case of government 100% owned and government promoted like urban authorities, as we have seen earlier, this is an urban authority decision. It has been made applicable even for the CA Institute. ICAI case also is mixed in this. So they say if they are doing some business activity because for its objects, public sake it is doing, being a government authority, for example, urban development authorities, buy the land, lay out the plots, and then sell the plots to public, construct residential flats, and then sell them, housing board like activity. So these activities are not commercial. These, because they come in the advancement of another object of general public utility, and that definition of section 215 GPU is having the proviso, if they undertake a commercial activity, then such a commercial activity gross receipts are exceeding 20% of the total gross receipts of the organization, then it is no longer a charitable purpose. This proviso, will it apply to government organizations like urban development authorities? The Supreme Court said no. Whereas in the case of others, it is applicable. Same activity, some others do, it becomes a commercial. Whereas the government is doing for the public benefit, it is not. So one should be careful in giving the audit report, to whom he is giving the audit report, and the word business and the trade commerce, whether it is carried on or not, in view of the Supreme Court decisions, one should have. So that's why the business and interpretation of the word trade commerce, we should be very careful. So if there is a thin margin, it is not a commercial activity. The Supreme Court, while giving those decisions, has said if there is a thin margin, only with the left hand you buy and with the right hand you sell. So with a very thin margin, it's not a commercial activity. It's only as part of the main activity. So what is thin margin varies from. Similarly, 44AB audit, is it applicable or not? No section is saying 11, 12, 13 is saying 44AB audit you get, but the audit report is asking, and the form 10A or 10AB also is asking, if you are having commercial activity, have you conducted this 44AB? So indirectly, as these procedures are prescribing this 44AB, one has to, if business activity is there. So what is incidental activity, what is not, as I have touched in the beginning itself. So this is the Karnataka High Court decision earlier saying that hostel is part of main activity, not a business activity. Similarly, the bus transport charges, Akash Education Society, the Delhi ITIT has said bus transport charges collected or hostel fees collected is not a incidental business activity. It is part of the main act, because to carry on the education, they are necessary. So what is incidental, what is not incidental? The auditor has to, with his discretion, must segregate and then apply thoroughly. Otherwise, say it is very difficult, very difficult. The opinion the auditor has taken may be based on some relevant case laws. He must express in this audit report itself. Otherwise, say the department may have a different view, and department view, if ultimately is there, they may take disciplinary action against the auditor. Why you have not certified? Why you have not brought to our knowledge? You said it is all part of main activity, but what made you to give such a report? They may subsequently ask. That's how one should be very careful on these things. So benefit to related persons. So actually, this is also an opinion, most probably, but the auditor must rely on the documents. For example, the trustees, by their qualification, are say working for the organization and take salary or remuneration. So in their professional capacity, when they are doing some service and then taking the remuneration, is it reasonable? Is it reasonable? If that is unreasonable, the auditor has to report that the benefit is passed on to interested persons. Maybe the trustees' buildings are given for rent to the trust operations. Maybe trustees take the salary. Maybe trustees give the personal money as loan and then take interest. There may be several transactions. There may be several transactions. So whenever the transactions are there, is it for the benefit of the trust or is it for the benefit of the trustee or say the specified persons? So the specified persons includes substantial donor. Substantial different donor means not only in the current previous year, cumulatively for all the previous years, if you donated more than 50,000 rupees, then it becomes, he becomes a substantial donor. That means specified person, 13.3. Any transactions with that person, whether it is for that person's benefit or for the benefit of the organization, one has to look into. That's how this auditor, while auditing, while expressing his opinion that no such benefit has been passed on because the new sections penalties are introduced. Once it is a specified benefit is passed on, that benefit of income is liable for 30% tax in the hands of the trust. And the recipient also under 56(2)(10) has to pay the tax because they received some benefit without consideration. And in addition to tax, 100% of the income is the penalty in the first year, 271 AAE. And if this is repeated in the second year, the penalty is 200% of the income, 200% of the benefit passed on to him. That is unreasonable benefit, not the total benefit, the unreasonable benefit. Whatever the benefit he got, the trustee or the specified person, then the tax, the penalty is there. So one should be very careful in dealing, having related party transactions. One should be very careful. Then impermissible investments, as I have told you, that the section 11(5) is violated, and that violation is caught in 13(1)(d). So if there is a impermissible investment after this amendment, so no penalty is prescribed, but the income will become taxable income under a specified income 115 BBI. So the 11(5) section itself has specified some items. Rule as per this 11(5), a rule is there which says the modes of investment. So one should be very careful in certifying that all the investments are all the deposits and investments. They used the word in section 11(5), deposit. Deposits means which you will get back. Investment means for income earning you made it. So the specific words deposits and investments are to be interpreted as per the law. And if they are complying under 11(5), then no problem. If there is no compliance, then the specified income, violated investment deposit income will become taxable income. Then the cancellation of registration, already we have seen this is a specified violation. So the specified violation will lead to cancellation of this thing. And these conditions are, once this income eligibility is not there, then only revenue expenditure is allowed. And such expenditure is also not from any loan or borrowing. From the current year income, only the revenue expenditure is allowed, not from loan or borrowing. And depreciation on assets, they will not allow. The normal depreciation also, they will not allow. Such expenditure is not from any contribution or donation to any person. So such contribution, any donations given will not be treated. Only for the objects related expenditure will be treated as application. So loss carry forward will not be given. And such expenditure, revenue expenditure also subject to 40A3 and 40A only is available. So once you violate this, 1310 will come into operation like this. So earlier specified violation cases, before the amendment, the 12AA3 was there. Now 12AB4 it has become. It is replaced. 12AA3 is replaced by 12AB subsection 4 is specified violation. So the earlier case laws will be useful. What they say, during the assessment stage, this violation has not been protested, has been accepted. Some evidence has not been given. Reasonable conditions have not been explained to the assessing officer. But when the commissioner is who granted the registration is trying to cancel as a specified violation, then a fresh evidence can be given, and still it can be argued that they have not violated. So that's how the specific violation 12AB4, these are the decisions, latest decisions. So one should be very careful in dealing with these things because it is a punitive section. One should have sufficient base to come out of that penalty like thing, the cancellation of this thing. For example, say for a particular religious community, amount shall not be used. Whereas in the case of this Cochin bench, Muslim Educational Society, the 2 to 5% of the students are of a particular religion. Because the name is there, Muslim, the department said for a particular religious community only you are serving, whereas the court held no question of violation. So one cannot draw somehow. Department may view it from a particular angle, but one should have say the clarity while doing the auditing itself that there is no violation. Unless we go through this number of decisions for and against the SSC, we will not be having the confidence when to certify what is meant by private religious purpose. So one should be careful. So these are all the decisions which will help the trust to defend its stand. So I have given some of these case laws. So one should go through leisurely. So for example, anonymous donations are taxable. One particular officer, in addition to making 30% taxable, again applied for 271(1)(c) penalty. So it cannot be. Similarly, the return is not filed. If the return is not filed, exemption is over. 11-12 you cannot avail. But for any SSC who failed to file a return within the time, 272 capital A 2 subclass E penalty is there. That is applicable. So in addition to you losing 11-12 exemption, because you have not filed the return within the time, though you have complied all the other sections, another penalty is also there. So like that, when it is applicable, when it is not applicable, one should be very careful. So still, this is a additional evidence can be given, as I said, at least during the CET cancellation, because CET cannot cancel suo motu without giving an opportunity to the trust. So when he gives a notice and he has to complete it within 6 months. So when he gives a notice, immediately the trust should respond with additional evidence and saying there is no violation, it's only an apprehension. So this is how one should be careful. So the specified income, as I told you already, so some of the violations we have already seen. If the accounts are not maintained, if the accounts are not audited, then the section 1310, only revenue income minus revenue expenditure, that is one type of taxation where it will become ordinary rate of taxation. Whereas 115 BBC, anonymous donations, 30% taxation. Similarly, 115 BBI, specified income, defined therein that if Form 10 or 9A is filed and its conditions are not satisfied. As I already told you, the 4 conditions are not in section 11(5) mode, not applied within 5 years, or within 5 years applied for some other object without the prior permission of the jurisdictional assessing officer. For all these violations, it becomes a specified income, which the auditor in his audit report has to specify, and in ITR also you have to report it and pay the tax. Similarly, section 11(5) mode violation read with 13(1)(d), just in the earlier previous slide we have seen, that income is also specified income. Similarly, for related party transactions, if there is a benefit passed on to person, similarly, the income is applied outside India without the permission of the government, then also in these circumstances, that income is known as specified income, which is liable to tax at 30%. Similarly, in the audit report, as I have told you, this Form 10B is having 49 clauses. In the 49 clauses, Form 10BB is having 32 clauses. Especially this 43 to 49, the numbers are not there in Form 10BB audit report for small people. Whereas for big trusts in the 10B, these are there. For example, the 269 SS, more than 20,000 borrowed by cash, more than 20,000 loan repaid by cash, 269T, or more than 2 lakhs cash receipt in one day by from one person, like the donation. Somebody wants, you are doing a good work trust, I want to give 5 lakhs cash, you received 5 lakhs single day from single person, 269 ST, that 5 lakhs penalty you have to pay. So this is all the things. So the agriculture income details, it asks how much, what is the income. So eligible depreciation details, these are all the extra in 10B. Whereas in 10BB, where instead of 49 classes, only 32 classes are there, these extra things are not there. So similarly, in this Form 10B, donations return 10BD. Now today is May 30th, tomorrow May 31st is the last date. Any charitable institution which has availed the Section 80C registration must file the 10BD, the return with the donor's details. 10BD has to be filed not only for the cash receipts, not only for this, say, in-kind receipts also, it's a reasonable market value. You must show and file the Form 10BD, donations annual return. So last date is May 31st. If there is a delay, 200 rupees per day. In addition, there is a penalty, which in the next slides we are going to see. So having got ATJ, the donations details are to be uploaded. And in the audit report, total donations, how much? Out of total donations, 10BD reported how much? 10BD reporting, you need the PAN card or say Aadhaar card or say the passport, some ID. 7 types of IDs are prescribed with the numbers. So with those ID numbers only, you can file Form 10BD uploading. Whereas in the audit report asks you to reconcile total donations received, out of that corpus fund donations, out of that anonymous donations, out of the 10BD reported donations, balance 10BD not reported donations, why they could not be reported. Total analysis has to be given by the auditor in his audit report. Similarly, in Form 10B, TDS received. See, normally for our expenditure, we pay the TDS. We deduct the money and pay. TDS receipt also has to be analyzed and given in this Form 10B. So TDS related 3 types of schedules they have given. So expenditure or payments liable for TDS, TDS deducted and not paid details, TDS deducted and paid promptly or say belatedly, then interest, whether it is how much interest is liable, were paid or not. Well, then the TDS returns, whether they have been filed promptly or not, the auditor has to report in his audit report. So in some cases, the auditor has to express an opinion rather than a fact, whereas majority of them are facts to be certified by the auditor. So this is how the audit report importance, audit report format, just like that copied and explaining you these are all the clauses. One should have once, twice, thrice, unless he reads, he cannot make the assessee furnish such information and then verify the information. So then alone he can satisfy that the compulsory, as I told you, in the Form 10B 49 clauses, clause 31 is the heart of the audit. He is certifying the taxable income. How he is certifying? He starts with gross income and then allowable application. 8 clauses are there. Each clause wise, as I told you, object wise, revenue expenditure, capital expenditure. So similarly, disallowable 13 clauses are there. So though it is applied, but you have violated those conditions, 40, capital A3, or say related party transaction, like that, 13 disallowance are there. All these things in one clause out of 49 clauses, the clause 31. One should meticulously go through the working papers one should keep, and then alone one can satisfy, yes, the audit report is without any liability. So these are all the important things. So I try to explain these things, only repetition only, for want of time I am rushing through. So but anyhow, as already 1 year is over, everyone would have got experience, but anyhow, a relook again, once again, second time. For example, in this class 38, any payment made to a person throughout the year cumulatively, if it exceeds 50 lakhs rupees, class 38. So for a single person, is there any payment exceeding 50 lakhs rupees? So this is nothing to do with the allowable application or disallowable amount, but an information to be culled out and certified by the auditor. Maybe an educational institution is having 10 buses. These 10 buses need diesel. They go to a particular petrol bunk and then get this petrol on diesel on a credit basis. So if throughout the year incurred expenditure is more than 50 lakhs, that person's name, address, PAN number, whether it is liable for TDS. Diesel purchase is not liable for TDS. So whether TDS sections are complied 194Q like that. The information sake, this trust auditor is casted with the duty to comply. So like this, these are all the things which meticulously one has to go through and then certify. Not like giving the audit report. This is in payment account, watching is there, all the complied. No, this audit report is so voluminous. One has to take care to comply. So I'm coming to the due dates. So as I told you, the due dates already I have explained. So Form 9A and 10, 2 months before the due date of filing of the return, and the audit reports 1 month prior to the due date of the return, and the return of income 31st October. One has to file. As I told you, this is the CBT circular, which says the return, if all the other things are there, return, even if it is filed before 31st December, yes, it is as if filed within the due date. So the delay condonation, number of circulars have come. These are the present applicable. For example, 10B audit report delay can be condoned. The 9A and Form 10 delay can be condoned. Up to 365 days, the jurisdictional commissioner has exemptions is having up to 3 years. Beyond 365 days, up to 3 years. For the total country, we are having only one principal CCIT delay. So that officer is having up to 3 years the condonation delay. Beyond that, the board. But for the return filing, no question of condonation of delay. If the return is filed, could not be filed before December 31st, there is no possibility of any condonation. Automatically 11 and 12 got cancelled. So the relevant case laws audit report filing, earlier old case laws also again revisited. So the accumulation filing also, some case laws are there. But as the condonation power is there, one should file them first, and then for the delay, condonation petition has to be filed before the commissioner. And though the CPC initially gives an opportunity, why there is a delay, why can't I make it taxable? Please wait, already a condonation petition is there before the commissioner. So commissioner let him dispose of. So, but a condonation petition, if he's not accepting, it's not an appealable thing. Condonation is not an appealable thing. So registration cancellation is an appealable thing, but condonation delay, because it's a dissatisfaction, we cannot go for this tribunal. So summary of how many types of taxable income is there. How many types of taxable income? As I told you, section 1310, that specific situational violations, so will become 4 types of violations. It becomes a normal income with basic slab rates, say basic exemption and slab rates applicable. Similarly, capital assets sold and it becomes a normal income. So similarly, 85% you could not apply. The shortfall also, 9A or Form 10 forms also you have not applied. Then automatically it will become a taxable income, but at normal rates. Similarly, 40A3 and 40A, to the extent not considered as application, it will become normal. So in these 4 situations, it results into income, but that income is liable for taxation with the basic exemption and the normal rates. Actually, there is a circular number 320, dated 11/1/1982. That CBTD circular even now says, whenever for these small violations, if there is a taxable income, that income shall be taxed at normal rates. That circular is even now valid, circular number 320, dated 11/1/1982. Whereas the other 3 situations, the bottom 3, 115 BBC, as I told you, 30% anonymous donation with surcharge and say cess, it is applicable. Similarly, specified income 115 BBA, 5 types of violation, which I have already seen, already explained, that is a 30% taxable. And similarly, specified violation, that is once the registration is not renewed, or your application, renewal application is rejected, or already given registration for a specified violation conditions is cancelled, then the trust is supposed to have accreted income. Accreted income means market value of all the assets minus third-party liabilities. Market value of all the liabilities, assets minus outstanding liabilities is the accreted income. On that accreted income, as per section 115 TD, maximum margin rate, sometimes maximum margin rate will go to 42.14% also. So on the market value, 10 years back, 20 years back, 30 years back, purchased land, building, they are at present market value, the accreted income has to be arrived and tax has to be paid within 15 days. So one should be very careful not to fall into the specified violation. Then alone one can save the trust. So the satisfaction of these conditions is more important. That's how it is there. Now we'll go to the penalties. Last but one slide. So the penalties, new penalties are there. So for the trust income, earlier there were no specific penalties, general violations, general penalties. As we all know, there are around 40 penalties in the Income Tax Act, and around 30 penalties out of 40 are covered by reasonable cause. That is 271 capital B, one can say avail that 273B, one can avail the reasonable cause. Thereby, the 30 types of penalties one can avoid, whereas the remaining 10 penalties are mandatory. Whereas here, the trust say any benefit to related party which is unreasonable. First time the income equal to 100% is the penalty. Next year, second year, third year, or any subsequent year, 200% of the income is liable for this 271 AA penalty. Similarly, for 10 BD, the donations annual return, as I have already told you, 200 rupees per day late fees from June 1st onwards. Last year they have extended one time, but now as on this date, there is no extension. One has to comply. If you file 10 BD within the time, it can be revised also. Better file the return and then you can revise also to avoid this penalties and these things. Late fees. The late fees is as per section 234G for 200 rupees. So similarly, 115 TD, as I have already explained you, so any specified violation on the total market value of the assets, one has to pay at the maximum margin rate. So that is either registration is existing registration cancelled, or fresh registration or say renewed registration is rejected, or fails to make an application in the previous year. So this I have completed in the given time my PPT. So any questions if the members are having, I request Akshita, then the moderator to give the questions. Thereby, I will get the opportunity of say. I thank the Direct Tax Committee for giving me this opportunity to share my views. I thank all the viewers so far patiently listening to me. This complicated trust taxation subject. But anyhow, by repeated going through, one can comply the law as expected by the statute. Thereby, the benefit to the society at large, public religious trust and public charitable trust, they are all for serving the society, availing the income tax exemption. So, as auditors, we can play a pivotal role in making the society get its benefit by availing this exemption. Thank you. Now, please go to Akshita.
Thank you, Sri Falguna sir, for contributing your exceptional knowledge on the topic. However, we have got some queries. The first one is an educational institution whose income is exempted under Section 1023C has let out its property to state government for residential school for BC girls. Is this income exempted or taxable under the head income from house property?
Your section for that education is on 1023C, small 3 AB or
Yeah,
AD.
small 3 AD, right.
Small 3 AD means whose gross receipts are not more than 5 crores. Small 3 AD. Small 3 AB means which is a trust receiving more than 50% of government grants. That is small 3 AB. You are saying small 3 AD. Small 3 AD is only existing education institution. It received from the building rents. So, which it has given to government. So, if it has given to government and the rents are received, it is also incidental property income only. Property income only. It need not go to house property head. It will become normal income only. Has it applied 85%? Actually, for small 3 AD, 85% also is not applicable. See, with the first 4 limbs, 1023C, small 3 AB AC, small 3 AD AE, this 85% application also is not applicable. So, if the conditions are first 2, 50% or more government grant should be there. Next 2, gross receipts from all the institutions. For example, education, you may have 3 colleges. Earlier, per college, 1 crore limit was there. But now, from 22 to 23, the total gross receipts shall not exceed 5 crores. Only if that condition is satisfied, definitely gross receipts include this government rents also received. No question of house property income, separate computation. Its total income is exempt. This is my answer. Okay. Next question.
While filing Form 10BD, donations received more than 2,000 cash and grants from NGO to be uploaded or not?
So, donations received. Any donation received to more than, actually, you are linking the question to ATG. ATG says a donor to avail ATG deduction more than 2,000, he should give through bank channel. That is a check or say bank transfer. So, here, the recipient side, whether the donor is eligible or not, the donations list includes more than 2,000 cash also, they must be uploaded. They must be uploaded. So, whether the donor is ineligible, for example, as I told you, donations in kind are not eligible for ATG. But Form 10BD says donations in kind also you upload. So donations in kind also are to be uploaded. Cash donations received more than 2,000 also are to be uploaded. This is the answer. Next.
Even if provisional registration up to 26-27 is granted, so do we file for registration before 30th of June 2024?
See, the question is part information only, but I presume that in 2021 or say early first quarter of 22, they would have applied for registration. The CPC has done the mistake. Up to 31/3/21, the old registration, if it is there, then they are supposed to give 5 years renewal, but they named it Form 10AC is named as provisional. So, provisional means 3 years only. That 26-27 means 5 years. So, though name is provisional, if 5 years renewal is given, you need not worry. CBTD, by its clarification in 2022, has said 22 September, I believe. 22 September. The date also, I think, September 22nd. So, 22nd September 2022, CBTD, by a clarification, has said that though it was provisional, so you need not worry, you take it as a permanent. That's what it said. So, you need not go for this 36-24 fresh registration, you need not go, because already it is there up to 26-27 assessment year. Yes, next question.
Now, this next query is regarding concerning regarding the tax exemption. New charitable trust is incorporated on 1st of November 2023. Accounts for financial year 23-24 are under audit. The trust desires to apply for income exemption under Section 12 and ATG exemption for donations in June 2024 based on the audited accounts of financial year 23-24. So please advise if the trust should go ahead with its applications as described above.
Instead of waiting up to audited accounts, without audited accounts also, immediately they should apply 2 Form 10As. One 10A for 12AB registration, another Form 10A for ATG registration, because it was registered, incorporated in October 2023. It is now they have to immediately apply for 12A registration at ATG. Then they will give provisional, and within 6 months they will ask you to apply for a final. If the activities are commenced, instead of Form 10A, they say 10AB. If the activities have not commenced, though October 23 it is incorporated, whether the activities are commenced or not is more important. Because from 1/10/23, the term Form 10A and 10AB application has been slightly changed. Activities commenced people, 10AB only. Activities not commenced people, 10A. So in 10AB, they should apply if their activities have already commenced without waiting for the audited 23-24 first year audited accounts. Don't wait. Even without accounts audited, you must apply. Better you apply. Then automatically they will give within 6 months another opportunity to prove your genuineness of the activities and audited accounts, then you can give. So this is my advice. Next.
A trust has applied for ATG in Form 10A in the year 2022 and got provisional registration. Filed Form 10AB after the commencement of activities and therefore rejected. The assessee withdrawn the Form 10A and filed again new Form 10A and obtained new provisional registration. And Form 10AB is also filed. How the assessee can get the benefit of Circular 7/2024?
You are right. The mistake of procedural compliance, a final opportunity is given. Circular number 7 of 2024, dated 25/4/2024. So this circular says those who could not comply within these limits, time limits, those who have forgotten, those whose applications were rejected, now they can apply fresh. And then, so this circular is applicable in this case particularly. They can go and then represent before the commissioner. Definitely they will get that ATG renewal, no problem. Registration and renewal, they can go for it. This is applicable. This 7 of 2024 CBIT circular is squarely applicable in this case, no problem. And they will give right from the first day. If you have withdrawn and applied, now you may get it. But if you want without withdrawal, that representation, if you say right from the provisional first day of provisional registration, you can get this. Donors also will get the benefit. Otherwise, say donors will lose the benefit. If the ATG is given from a subsequent date, they will lose the benefit. You can try for original date and original benefit also. Next.
A charitable trust has submitted a FDR of rupees 5 crore to Medical Council of India as a security in accordance with the requirements of MCI for permission to its medical college. Whether the said 5 crore can be treated as application of income? If yes, then whether the said security, when received back, will be treated as a part of gross receipt?
Oh, no, see, 5 crore you are saying 5 crores bank FD you made and gave as guarantee to the Medical Council of India to get the medical college permission. So, this 5 crores, I believe, is not from income. If the trustees have given donations of 5 crores, normal donations, out of 5 crores they made the FD, and that bank FD they have given as guarantee to the Medical Council of India to get the medical college permission, then it is not an application. Actually, applied means for objects you should spend. So the FD ownership you have not lost. You are still the owner of that 5 crores FD that you are given as a security. So then it is not an application. Application means either revenue expenditure or capital expenditure. Capital expenditure means an asset. So the FD is not a capital expenditure. It's only a deposit. So the FD you made and gave. So then better in such case, the donor should have made it as a corpus fund donation. Corpus fund donation is kept as FD. So corpus fund exemption 11(1)(d) you claim in the year of receipt. That corpus fund automatically made as FD. This FD is given as a guarantee. So nothing, no taxable income will come. That's how one should view it. Okay, next.
If the trust has received CSR fund, then the trust is free to use those funds towards its objectives.
The company which is giving the CSR funds for this trust to apply, is it unconditionally given? If it is unconditionally given for your objects, you can use it. 85%, it becomes income in the year of receipt, and 85% you apply, or shortfall, file form 10 or form 9 year, you do it. Normally, it will not be the case, because the trust before receiving CSR funds itself, trust should go under the Companies Act and then register itself. I am eligible to receive CSR funds, it should say. So once it receives, it should give the utilization certificate. How much funds you received? How much funds utilized every year? CSR funds received may not be spent applied in the same year, maybe 1 year, 2 years. So all this procedure is there. So if the donor unconditionally has given, my answer is yes to your question. You can free to use for your objects. But donor, you are having 4 objects, let us say. Relief to poor, education. Donor might have given only for education. Then for the education purpose, you should apply the money. If it is given for relief to poor, because The Companies Act is having a specific schedule of CSR activities. For those CSR activities only the money shall be given used. Then only it is CSR expenditure. The obligation cast on the limited company. So this donee received trust also must satisfy those conditions. For that particular purpose only they choose. This is the next.
Can a trust operating schools pay management fee to a management company where the trustee is also a director, or a firm where the trustee is a partner? Can payment be less than the market rate or on arm's length basis?
No. What is the transaction between the related party? Trustee is also a managing partner or managing director. What is the nature of transaction between the company and this trust? Is it rent paid or say interest paid or say trust? What type of expenditure trust is incurring? In your question.
They have paid the management fees. I think.
Oh, management fee. So because the trustee is managing, they want to pay them. Trustees for a discharge of the liability as a trustee, no rupee, 1 rupee remuneration shall be taken. So trustees to discharge their duty as a trustee, to manage the trust, no management fees remuneration shall be taken. It amounts to 100% violation. Other than trust management, any other professional services, like he is a qualified doctor, the trustee is a hospital. He works in the hospital. So at par with the other doctor, the trustee is receiving the salary. That remuneration is permissible. Whereas here, for managing the trust, if they take the remuneration, it is 100% violation, liable that 115 BBI and all these things will fall.
But sir, they have not paid the management fees to the trustee directly. They have paid it to some company, management company, wherein the trustee is the director of that management company. Still, that could not be.
You are right. Please go through that section 13, subsection 3 related parties. The related party includes trust interested 5% or more share if this trustee is having in that company, then it is a related party. Any payment related relative definition and related parties are exhaustively given. So this comes squarely in that. Be careful, please. Next.
Right. Should all the payments to trustees be mentioned under section 13, subsection 3, or only to the extent it is unreasonable?
Yes. The list is given in section 13.2. 8 transactions are given for example, not exhaustive list. 13.2 gives an example listed transactions where it says unreasonableness is the benefit passed on. To the extent reasonableness, no question of violation. That is the answer.
Okay.
Okay.
The next is, what is the liability of trustees for violation of trust registration terms?
Your question, trust registration condition, trust deed registered by the trustees. Then the income tax registration, the trustees have to satisfy the income tax conditions and apply. Where is that violation? Trust registration, it's a trust deed registration or say income tax registration. Where is the violation?
The violation is in the trust registration.
Trust registration, then we are nothing to do with income tax. Trust law, Indian Trust Act and trust law is a very big subject. Now, what is the trustee's liability? Now, under the Income Tax Act, we cannot now deal with it. It's a very big subject.
Whom to approach in case delay of Form 10B of the audit report beyond 3 years?
The Principal Chief Commissioner of Income Tax, Delhi, in the website, it is portal is there. Up to 1 year, the commissioner. Up to 3 years, Principal Chief Commissioner. Beyond 3 years, under 119(2)B, if there is a reasonable cause, board, section 119(2)B, the CBTD is having the power for any delay condonation. Beyond 3 years. Up to 3 years, Principal Chief Commissioner, Delhi. Okay, exhausted.
Okay. Thank you, sir. Yes, done, sir. Thank you, sir, for your exceptional presentation on the taxation of charitable trust, wherein this was the part B regarding accounts, audit, and taxation part. Your comprehensive PowerPoint, which was the presentation which was made, it covered almost all the pertinent sections and provisions of the Income Tax Act, and it also included insightful case studies that helped demystify this complex subject. Your meticulous attention in detail and thorough explanations regarding the requirements and processes of Form 10D and 10BB the conditions of Section 11, the proper maintenance of accounts before proceeding with an audit, the application of expenditure, violations of 1023C, recent amendments and restrictions, insights to implications of Form 10. And regarding all of the sections which I covered above, the knowledge was really invaluable. Your expertise and dedication to sharing knowledge have greatly enhanced our understanding of the taxation landscape for charitable entities. We are incredibly grateful for the opportunity to learn from you, sir. On behalf of the DTC of ICAI, I would like to extend our heartfelt gratitude for your invaluable contribution to our session on the taxation of charitable trust. Your expertise and insights provided our audience with a comprehensive understanding of this complex subject matter. Your dedication to sharing knowledge and enriching others is truly commendable, sir. And we are immensely grateful for the time and effort you have put in your exceptional presentation. Thank you once again, sir,
Thank
for
you.
your outstanding contribution.
I thank all the participants. I thank the ICAI.
We would also like to thank CA Piyush Chajit sir and the entire DTC team to conduct such a wonderful presentation on such topics, and we request for such more topics in future for enlightening all of us. Thank you once again, everyone. Thank you, sir.
Willie. Kotaji,
Thank you, sir.
thank you so much. So within the time I could cover.
Yeah, good, sir.
Thank you.
Thank you, sir.